report for April 28th, 2012. Quickly, we've got a bullish normal market that is at the high end of normal on weekly RSI 14 at 64 out of 100, at 93 out of 100 on 10-day NDX, so we're just into the overbought condition. Percent stretch above the 200-day moving average is 10.88. That is green bullish, so we've made a recovery from last week when we were down into white bullish. Slope of the 50 is still slightly below average at positive 0.36%. That's yellow, and I rate that as neutral. ADX has come all the way back down now to 16.3, which is neutral. We're right at the area from which an intermediate term trend can actually begin to unfold now. We've had enough sideways and price action and pullbacks that we actually could see another move from this area. So that's a good thing for the bulls. Relative volatility at 1.17%. We're in the middle of the normal range now. We've come up from a couple weeks ago. We were down around 0.8. So the sideways chop of the last couple weeks has raised ATR percentage considerably. Excuse me. Monday we'll be looking at the rebalancing in the portfolio. Right now we're holding Qs, XLF, and MDY in the 26. Among the 13 ETFs, it's the Qs, MDY, and IWM, and we're looking at a reevaluation early next week, like Monday. ETF 2, theoretical exposure is recommended at 90%. The model portfolio this should read at 90%. We're going to take a look at the blended monthly rebalancing next to see what the holdings are. Make it a little easier to read there. All right, under the 13 ETF portfolio, we're still looking at the top three being the Qs. Now SPY has moved into the second position here at 74, as has IYR at 74. So it'll be technology, U.S. large caps, and U.S. real estate. In the 13 ETF portfolio, or in the 26, excuse me, it's the Qs, XLF, which are financials, and then U.S. real estate and SPY. And then if we look at the 26, you see it's being dominated by everything U.S. right now: technology, financials, real estate, large caps, mid caps, the diamonds, and the small caps. All of those being strong U.S. sectors. So that's definitely where the market is pointing us. I'm looking at adding a new report that is an extract from the ETF2 database. As you know, right now we're showing the report that is filtered by the 100,000 shares minimum, and I'm coming to the opinion that what we got to do is take a look at the unfiltered database as a guide to those low volume ETFs that are reflecting strength in certain parts of the world. Bob Gardner reminded me of this during the week when we were looking at winners over at ETF Replay, and a lot of them were small countries that make up the civets, like Colombia, India, Vietnam, Ecuador, Thailand, and those don't have the kind of volume that we need yet for the ETF2 system. However, that's going to be one way that we could start identifying those early emerging leaders that will be like the Brazils and the Latin Americas of the next decade. So I'm thinking I will be adding a page in here where we take out the liquidity filter so that we can find the real sources of strength. And that may give us an unfiltered look at the real leaders that we may be able to frame individually as swing trades. So starting next week, I'll have that in the report. And those of you that have the spreadsheets can just do that anyway, just by going to the liquidity filter and turning that off or setting it low. So you can always run those numbers. Okay, moving on. Next up is the market health check. And vertical blue lines represent 10, 20, and 30 days of look back. Horizontal purple line at 142 is reflecting the previous swing high, which happened earlier this year, you can see. And the horizontal red lines represent key support levels that have held in previous markets. You can see here at 134, at 137, we've had some support. The central black line represents the 30-period regression line, and I've used the Andrews pitchfork tool in order to project that forward. So that basically shows where the price channel should take us, provided there's no change to the underlying process that's generating the current market return. So if you think of the current market psychology as being a collection of ideas and positions, beliefs, values, systems, and all that, that there is a certain normal out there right now that is generating the kinds of returns that we've seen over the last 30 days. And so the idea behind the RAF regression channel is to project that forward and say that until something fundamental changes in the underlying market conditions, then price should stay in that channel. And therefore, we offset that channel by 1 day to determine if today's price action, and this, which I'm highlighting here, to see if that violated the channel that's formed by the maximum excursion during the 30-day look-back period. We see that on Friday. Friday's price action is pushing the boundaries of that right on the upside. And so what we can say then is that if we see a close outside of that channel, then there's reason to believe that whatever was causing this pullback has been violated. And you'll see what that would almost equate to is a little yellow zone here between 140 and 142, which is the swing high. And then clearly a close above 142 would signal an end to this pullback period, which seems to have found support around 138. And then that would generate the potential for a new upward trend. And that upward trend can definitely last a couple weeks and be worth another 10 points, because as you can see, the ADX has now pulled back to around 15. We just had the plus DI cross over the minus DI, so that's the beginning of upward trending potential. And you can see the 10-period moving average has pulled back to the 50 and has now rebounded. Price is now in front of the 10, which is above the 50, which is above the 200, and all that's very favorable. And we have ADX now postured to where it can actually support a developing trend from here. So we've had almost 20 days, actually really 30 days of price stuck here between 137 and 142, and it's tested the top of that channel a couple times, had a sharp pullback, found support, failed to fail further, never really violated this 5% price box, which represents, a noise pullback from the swing high down to about 5%. It tested it pretty closely here, but it never violated that 5%. It would be officially a correction if it went between 5 and 10%. So this is clearly a dip that we should be buying. And the 50-period moving average, although it has the upward slope has cooled off here, as you can see, and is indicated on our market mosaic when it went to yellow, we still have the potential here for the beginning of a nice move. We just got into overbought conditions here, and we know from previous bull moves that it can stay overbought for a long time. The percent price oscillator, PPO, has it closed its jaws around Wednesday of last week. and open those jaws upward, and so we have the potential for a nice move on an intermediate basis just using that indicator as well. So this is really looking favorable for the buy on dip opportunities. And then if we scroll down just a little bit further, we can see the 30-day slope indicator on stock charts, which after a period of upward movement came all the way back down below the zero line, so slope actually got negative, as you can see right now. But it has found a bottom and is slowly starting to improve. So all of the intermediate term technical indicators point to potential for a nice move here, and it has stabilized after 30 days of sideways choppy and channel. So this is actually very favorable for the upside. It's found the support level, never really got into correction territory. This looks like a natural respiratory pause. So very favorable for the bulls here. I'm long, and I think you want to have a long side bias right now. Taking a look at the world market model, the top 10s. And what we have is 9 out of the 10 are above their moving average filter. Only ILF is below it. So that leaves us again at 90% invested, 10% cash. SPY is better than EFA because 68 is better than 60 in the average column. And then among the U.S., it still remains technology, large caps, mid caps, and small caps. So this is a provisional risk on trade where the technology large caps led by Apple and Microsoft have been doing well, and then followed by the broader market, and then the risk on trade of mid caps and small caps following along. Two strongest sectors, the Qs and the U.S. large caps, two weakest, Japan and Latin America. Lisa asked me, when I say we should be buying, what exactly do I mean? I mean that we should have a long side bias for signals for bullish conditions, whether that's blended monthly rebalancing or channeling signals or the swing trade system of your choice. The market condition right now is favorable for swing trading. So that means be aggressive with swing trade signals. All right, moving on. Quick look at the world market model next. We have the U.S. is above average, and technology, the Qs at 80 are in the green, so that's exceptionally above average. All of Asia is lagging. Only the growth in Europe is above average, and that's due to the technology market sector. Inside Asia, it's Malaysia and Singapore above average. China, Australia, and India continue to lag. Mexico is above average, but Canada and Brazil, especially Brazil, are way below average. U.S. real estate continues to be strong. Oil has made a rebound. Gold and silver are in the red. I think they're poised for a run up. I think they've had a nice support level been established recently, and I think they're back to something like fair value. So I'm looking to accumulate silver. Inside the business sectors of the world, financials, technology, and consumer discretion are leading the way. The healthcare and the consumer staples have come out of the yellow and red and now are back up above average. I think that's been personally a flight to quality here the last couple of weeks as we've seen the market stalling. Things like Johnson & Johnson, Merck, Travelers, those have been doing relatively well. But this still remains a U.S.-led market right now. You should use that to guide your decision making. Next up is the top 30 from the ETF2 database, and sorted by the average column. So we still have the typical winners: home construction, retail, biotechs, Spider, S&P retail Spider, technology, the Qs, regional banks, consumer discretionary tech, semis, pharmaceuticals, biotech. You can see where this is all leading. It's all U.S. centric and in the leading business sectors of the last 4 or 5 months. Moving on. Same concept now applied to the Dow 30. The winners from last week and really for the last 2 months continue to be the strong ones. Home Depot, American Express, J.P. Morgan, Coke, and Disney in the top 5. The bottom 5: Alcoa, Caterpillar, Walmart, Johnson & Johnson, Procter & Gamble. I still think there's value to be bought, to be found in those near the bottom, but also I think you got to respect the strength of these up here at the top. As an example, Lisa, one of the things, if I don't have any other ideas going on, and if I see Home Depot moving up and stronger than the market intraday, that's an easy one for me to buy. Go take a look at its daily charts, and that's what strength looks like. So when all else fails, buy strength. Take a look at the volatility charts next. And you can see that we've had a slight uptick here in volatility the last 30 days or so. It found a bottom down here around 0.5%. This is based off 30-day standard deviation, not the 14-day ATR percentage. But I'm always trying to be alert to the return of volatility into the market. These last 30 days in here have been a reflection of that sideways chop that we've seen. This dip to very low volatility corresponded with the end of that bullish move up, and now we've been chopping sideways, and that's why we're kind of back here to low normal on this 30-day standard deviation. So still well within the bounds of a quiet to normal market in terms of volatility. I want to shift gears now over to the daily report. So if you just hold on a second, we'll get that queued up here. Oops, I'm sorry, I got the wrong one. Let me get the daily on here. Okay, next up is the daily report. I'm not going to read the top bar again, so we'll just jump right to the gap statistics, looking at the last 30 days. So the market has gapped down 16 times in the last 30 trading days. 6 and 10 here you can see. 10 times the market has reversed to close higher for an average follow-through of 0.37. 6 out of 16 times it has failed further for a minus 0.58. What that tells me is the last 30 days have started to reward those violations of lower lows. So when it breaks down to a new low, that has been a precursor to greater gains on the downside, so for a short side position. Conversely, the gap ups 14 times in the last 30 days, and the big follow-through has been gap up and go. So what this tells you is once price has gotten out of the daily yellow zone, in other words, above yesterday's high or low, there have been room for it to continue to trend and to make some gains. You can see on the 10-day NDX time series here, where we've been oversold for a couple, or overbought for a couple days. You can see based on the ATR percentage, the volatility has gotten back to normal from the lows. It's now right smack in the middle of the last 100 days in terms of volatility. Market ADX, you can see, has declined down to just around 15, but the plus DI has now crossed back over the minus DI, and that's favorable for the next leg being up. Only Procter & Gamble has any patterns for us here. That's it's both channeling and overreaction. 10-day max pain, Bank of America, Walmart, Caterpillar, Procter & Gamble, and Alcoa. So Procter & Gamble should be on your short list. In the auto framer, got a number of signals that test out at 2-to-1. Procter & Gamble, Cliffs Natural Resources, Bank of America, Brazil Silver, Walmart, the VIX, Caterpillar. Moving on. Taking a look at the Dow Tactical now. See a handful of dojis and only Procter & Gamble firing on the channeling and overreaction. What makes that nice is it tests out at 2.7 on the auto framer, and it's number 3 in terms of max pain range compression, so that's all favorable. As a potential one-day rebound among a must-own consumer staple company. So when that one rebounds, it'll be nice. I also like that Caterpillar and Walmart test out at better than 4-to-1 on the reward to risk ratio. I mean, those are two companies that are going to be around. I like Alcoa with a 4.5 frog quality number. It was a big percent loser on Friday and is in number 2 position on max pain range compression. So that's going to be a really important one for me to stock for intraday trading. Coca-Cola just quietly had a big day up. No patterns to speak of, but you can see that it's been among the exceptional leaders here. 1 day and 10 day, 1 month and 3 months, and had a breakout, a pretty significant breakout above its 10-day trading range. Coca-Cola is one that you should have your sights on. It's a must-own, and let's remember to take a look at their chart here at the end of this presentation. So I'm going to look at Coke and Procter & Gamble and Alcoa. ETF 30 summary. The VIX has been interesting lately because of this return of volatility to the market, and it's testing out at 5.4-to-1 and had a doji on Friday, so I'll be trading that intraday. I like Brazil as a trading vehicle. It's got a 3.3 frog quality number, has sold off 10 days and 1 month, and tests out at 3.0-to-1 on the auto framer, so that'll be on my short list also. Moving on. Taking a look at the market mosaic indicators here. We're seeing a little recovery here. If you look at the long time series on the 30-day regression line slope, it has actually started to get an improvement here right at the 0 line. It's a dotted red line. On the zoom in, it looks like this. It's actually made a reverse direction and starting to get better based on the price performance of the last 3 days. Again, it's got to get through 142 to be significant here. But if it gets above 142, this base that's been established here between like 137 and 140 is going to be a very powerful springboard. I think this is the place where everybody that was going to sell short term has sold, and now there's a resumption of buying pressure here. And percent stretch above the 200 has been in a stall also at the +1 standard deviation, but now started to improve. So this, I think, bodes well for the intermediate term swing trader. This is good swing trading territory. Not going to dwell on the signal to noise or the frog numbers. I've expanded the look back period on the holding X day chart here. So now I've gone now back 9 years instead of just the 5 that I was doing before. So it's about 2,200 days of look back period, just because I think this is more and more important when it comes to estimating where we are inside these swing trade kinds of moves. And I'm working on some charts to make this easier to visualize. But I think this is becoming a more and more important part of my own estimate of where the market is and how much is still available forward. That I wanted to start expanding the data set on it. To that end, then, let's just take a quick look at SPY. Over the last 5 days, SPY has returned 1.77. That comes in at a z-score of 0.62, so still within normal range. This move over the last 5 days has been a normal move. Over the last 10 days, it's returned 2.37. Z-score is also 0.6. That's still well within normal, so you're not buying at after it's had an extraordinary move up, so that's good to know. The Z-score, looking back 20 days, it's just 0.1, and so that's favorable. And then at over 40 days, it's only Z-scores at 0.18. So what this says is the sideways move, which never ever got more than 5% below the swing low, has cooled the market off, but not stalled it. And the moves of the last week have actually been strong enough to halt the downward move of the regression line. And so I think this is more evidence that we're well suited for a move upward, and the swing trade time frame should be emphasized. I want to take a look at the safe zone channel next. I really like this idea, and I'm trying to decide whether I like this or the Z-score is better. But what we can see here, just looking at Elder's technique with my adaptation, that we've pushed the upper noise channel boundary now 3 times and are above that, and that's very favorable. And again, if we get above 142, this is going to start taking off. That's everything I want to cover on the daily. I would just want to look at a few charts now, some tactical charts, if we can. Let me get those queued up. So I want to take a look at Alcoa. I actually like this for Alcoa. This is very favorable for me as a trader here. We're right near the 50, and the 200 is coming back to catch us. So what we've got is this 3-month period of sideways channeling, and now with the sell-off on Friday, with price down around 9.75, I'm on the right side of 10. 10 is kind of the normal. I like to buy it below 10 when I can, because the moves, when it makes its moves, it makes nice swing trade moves like this from, say, 9.5 to 10.5. That's a 10% move, and then when it peaks there, it has these nice long downward moves, then upward moves, then downward moves. So the last 4 out of 5 have been up, finding local support at 9.6. Now if I can buy it around 9.7 as it's going up, when it gets above 10, I would expect my next target to be 10.5, and that'll be a nice swing trade potential for me. So I like Alcoa, and we wanted to look at Procter & Gamble. Oh, this is excellent. This constitutes something like an overreaction potential. So I look back, I see support at the 200, and although there could be a nice one-day play in here, I would look to see support down around 63. I'm looking for rebounds. Then if it can get above 65 1/4, I see it looking to try to close the gap. Fair value looks like 66 1/2. So Procter & Gamble has an opportunity to do some good for us there. I would treat that as a one-day trade until we sort out what that the reason for that one-day sell-off was. The last one I want to look at is Home Depot. Home Depot. And this is what strength looks like. And so this is why Home Depot right now is my go-to. What do I do when I don't know what to do? And that is anytime that it's working better than the S&P and it's going up, it's a nice one-day intraday trade for me. Good place to park money and a strong mover. But it's hard to be much more efficient than that line right there. And that's why it's the #1 stock in the Dow using our 3-month and 6-month blended look back, and then using the discipline of the consistency and quality ratings as well. So that's what strength looks like. That's something we should be interested in knowing. Okay, so that's everything from Tortoise Capital. I'll get this processed and hang the video, and looking forward to trading this week and seeing you guys in the trading room. Got some good ideas percolating from the last workshop out in Raleigh. It looks like what we're going to do is we're going to add another core trading or core investing workshop out there. That was pretty popular with some new folks. So we'll probably do that in July. I'm working with them for a 2-day or 3. I think it's either going to be a 2-day or 3-day intensive frog trading workshop. Frog trading only. Our intent is to through webinars and the readings, have folks do the homework on the rule sets, and then work about 100 rapid fire trade examples over those 3 days in person. So what we'll do is it'll basically be drill and repetition, looking at 100 real days in the market, the real trades, and practice trading all the different combinations of the frog. Focusing just on that system, no other system at that time, and that's tentatively scheduled for August. Depending on how the simulator that Frank Eves at IITM is working on, depending on how well that comes out, that may be something I can do out here in Kansas City over a weekend too. If not, if I do this in Kansas City, it would be with case studies in the form of rapid fire charts, but probably not automated. But my sense is that there's an interest out there for folks that want to really concentrate on a particular system and master it, and so that's the direction that IITM and I want to go in, and that is continue to offer the same set of seminars, but also offer some new ones where you can just concentrate on the trade patterns of interest, and then trade a lot of them. And really start developing focused practice and focused mastery. So look for more news about that in the near future. Anyway, that's all the news from Kansas. The girls played in outstanding fashion. We beat teams that were in higher level divisions, and we dominated them. And the girls made great strides in their mental toughness. Part of that is I've come across a pretty nice inventory tool that examines mental toughness that we use in the Army, that identifies the different components of mental toughness and then helps pinpoint how those things can be worked on. It looks very promising. I'm looking to adapt that to trading, because I believe that the two processes are so close together that the mental toughness that we use to strengthen the emotional resiliency of our Army officers can be applied in the trading rooms for traders just as well. And so I'm looking to adapt some of that. I think between that and then the learning styles stuff I do with brain mode power can help provide an edge to individual traders. So I'll be doing some work on that this week as well. So anyway, take good care, guys, and we'll be in touch, and look to see you in the trading room.